Well, welcome and thank you all for taking the time to be with us this morning. Some housekeeping items first. The webinar is being recorded and a copy of it will be sent to clients shortly after. We have a lot to unpack this morning and only have about 30 minutes together, so we will not be taking questions during the webinar, but if you have questions, please reach out to your relationship manager or any of us on the call today. If you have already submitted a question to us using the Ask a Question button in the invite you received, we thank you for that, and we'll do our very best to answer it during the webinar today. So let me first introduce my colleagues, Steve Brudos, Ryan Bergan, and Leslie Klinski. Steve and Ryan are portfolio managers. Steve specializes in fixed income, while Ryan specializes in equities. Both, as you know, have been regular contributors to these webinars. But this morning, we also have the pleasure to have Leslie with us. Leslie is a relationship manager with our wealth management group. Leslie has multiple specialties, one of them being planning. So Leslie will spend 5 to 10 minutes at the end of the webinar today discussing planning opportunities at year end. Steve, Ryan, Leslie, welcome and thank you for being here. The first topic listed on our invitation to this webinar read something like, election is over, now what? So let's talk about that first. Well, the midterm election was 3 weeks ago, but it took a little while before we know what we know today. So we know now that the Senate will stay Democrats and the House will now be Republicans, as Republicans, as you can see here, gain 9 seats from the Democrats in the House. Inflation was the number one concern for voters leading into the midterm election, and we believe that helped Republicans. But on the flip side, the labor market, which is still very healthy, and the abortion issue, we think helped the Democrats. At the end of the day, I think it's fair to say that the Republicans were simply not able to win the swing vote and really convince independent voters to vote for them. And that's probably what made the biggest difference. So what does that all mean? Well, first of all, it means that our country is still very divided, right? This is why we titled the slide, it's a 50-50 country. A slim GOP House majority and a narrow Democratic Senate is an outcome most likely to produce a legislative gridlock for the next 2 years. So we would expect really a fiscal freeze in Washington for the next 2 years with no tax increases and no large spending packages, unless there's a severe recession next year and both parties then have to come together to help the economy. But other than that, we believe the legislative agenda will be very limited over the next 2 years. Ultimately, the stock and bond markets will continue, we believe, to be mostly influenced not by the election results, but by fundamentals, including monetary policy and corporate profits. So before we move on to discuss monetary policy and corporate profits in greater detail, I want to provide a quick recap of market returns so far this year. The chart here shows calendar year returns going back to 2007, and the column to the far right shows 2022 year-to-date returns as of last Friday. If you look at the top right of the page, only 2 categories, cash and commodities, have posted positive returns so far this year. When we look at bonds in the blue box here are down 12.8% so far this year, and equities, mostly captured in the red box, are down anywhere from 14% to 21%. So it has been a difficult year across the board with really very few places to hide. So where are we going from here? Well, for equity markets, we know that economic growth is important. because economic growth correlates well with sales and earnings are the main driver of equity returns long term. So the question we ask ourselves is, where are we in the economic cycle? Well, there are two lines in this chart. The full orange line represents the global manufacturing PMI, which is a global proxy for manufacturing activity. And manufacturing activity tends to correlate closely with services activity. So we're using manufacturing activity here as a proxy for global economic activity. The dotted orange line is the model, a forward-looking model trying to assess what global manufacturing activity will likely be 9 months or so from now. A reading of 47 for September 2023, as the model is currently predicting, would indicate contraction in the economy, 50 really being the threshold between expansion and contraction. At this point, the model cannot tell us anything about Q4 of 2023 or 2024 for that matter, but what the model is telling us is that the economic outlook for the next 9 months or so is not that great. If you look at the factors that make up the model, they are listed right in the middle of the chart here. The main reason the model is negative on growth going forward is because rates or yields are up a lot this year. In fact, looking all the way back to 1954, we've had a total of 13 monetary tightening cycles, so 13 periods of rising interest rates driven by the Federal Reserve. And 10 of those quickly led to a recession. So the odds are not in our favor here. So our base case scenario, therefore, remains that a global recession will unfold next year. So Steve, I'll ask you to jump in here and maybe explain how rising interest rate, how the rising cost of money depressed economic growth.
Sure, thanks, Jan. And you can move ahead to the next slide. Really, the Federal Reserve has had their foot firmly on the brakes all year long, and you can think of rate hikes as, the brakes on a car. The Fed is raising interest rates to slow down the car or the economy in this analogy. So as the Fed has raised rates, the housing market has cooled off, because higher mortgage rates and less affordability for consumers, and consumers are also paying higher credit card rates. HELOC loan rates, auto loan rates are higher. So all of this kind of translates to consumers who are maybe less willing, less able, to pay higher and higher prices for goods and services. So eventually you have that trickle down, corporate earnings tend to cool off, and ultimately the job market may weaken as, businesses are less willing to hire, or actually they start to lay people off. So this slowing of the economy has certainly been the goal, of the Fed this year, as they're trying really to keep inflation in check and bring it back down, closer to its target. Now, in January of this year, the Fed thought 1.75% would be enough to accomplish their goal. So this certainly has not been the case, and rate hike expectations have continued to ratchet higher and higher, as shown in this chart. And this has certainly pressured interest rates to the highest levels in 10 plus years. Now, the current terminal rate or expectations for peak Fed funds is all the way up to 5%. So short-term rates have already raised to nearly 4% and are likely to, see the actual Fed funds rate approach that expected 5%, as shown on the chart, as we move into, the first part of next year. So we know that a lot can change by then, but as this slide illustrates, the path to slow the economy has certainly been very aggressive. High inflation has warranted this action from the Fed, and the Fed is likely to, keep their foot on the brakes and hike rates until it sees sustained progress towards its goal of bringing inflation down and economic activity down. So at this point, I'm going to turn it over to Ryan. Ryan, can you talk more about the forecast for, corporate revenues and profits, given some of these higher borrowing costs and potential for slowing economic growth?
Yeah, thanks, Steve. So as Steve just said, what I'd like just to spend a few minutes on is just to provide our thoughts on corporate sales and earnings, and which we know is a fundamental driver of stock prices. And so based on the high level of interest rates today, as Steve just discussed, and the economic growth expectations that Jan talked about, we do think investors should expect a period here of slowing corporate sales, and importantly, for earnings to then contract, which unfortunately it's not a good sign for the stock market as we head into next year. What I'd like to do is maybe just take a step back and kind of look backwards a little bit to help understand this predicament we're in just a little bit better. So if we go back to the early days of the pandemic, we saw profits ballooning from massive monetary and fiscal stimulus that supported the stay-at-home spending bubble, leading to a surge in sales, and really it was to unsustainably high levels. Now today, unit demand is starting to slow. We're seeing that as evidenced by new corporate sales are rolling over, and corporate sales have also received the benefit of inflation as customers have been willing to pay higher prices. And of course, we've all seen that and experienced it ourselves. Now, once we get a confirmed rollover in inflation, that of course indicates prices are coming down. But if these lower prices are combined with slowing demand, sales will slow. And really, it already has, depicted on the next slide. So as sales growth slows, and it doesn't really have to be by a lot, combined with fixed costs and higher wages, this should place further downward pressure on corporate profit margins to the detriment of earnings. Now, if we take a look at sales across the economy, there is evidence that corporate spending is slowing. Take slowing advertising revenues as an example, which is a pretty clear tell. And consumer demand is slowing with volumes declining. We saw retail and consumer discretionary companies that actually had pretty good third quarters and beat earnings expectations. Well, they did so via higher prices, not greater demand. And so we're seeing more companies, we're seeing companies really reporting that consumers are trading down to lower priced items. And so price hikes are really becoming more difficult to push through. And we do really think there is more room for demand to fall further, as demand for the service industries still remains pretty strong. Airlines and hotels seeing still pretty good demand, where that post-pandemic reopening boost is still continuing. I think a pretty reliable way to kind of reinforce what I'm saying and this concern around falling sales growth, and of course the unexpected earnings growth contraction, is shown on the next slide. We talk about business confidence of corporate CEOs, and that's depicted by the blue line in the chart. It has a very strong relationship with earnings growth expectations, which is the red line, over next 12 months periods. Now that confidence is at levels we haven't seen, we can see here since 08-09. Looks like it's similar to levels in 2000-2001, both of course were recessionary periods. And it was also worse now where it's at than what we saw in the brief pandemic recession in 2020. Therefore, I think it seems reasonable that earnings do have further to fall, as the historical trend would suggest based on CEO confidence. Even anecdotally, in the last couple of quarters, we've heard from about 40% of S&P 500 company CEOs cite the word recession during their quarterly earnings calls with investors and analysts. And this is well higher than the last 5-year average of only about 10% in a quarter. And I think it's the most since about 2010. So we believe this is very telling, as CEOs know their company's future prospects, including their outlook for earnings, better than anyone else. And thus far, home builders and tech companies, retailers, they've been among the most bearish of companies, citing, slowing demand in their businesses. So I think before I hand it back over to Steve here, I think it's important for us to put into context how far we think earnings growth could fall over the next few months, because that's really what we want to know and what it could mean for stocks. I think it's important to note that earnings are backward looking, meaning the impacts on businesses from higher inflation and higher interest rates, slowing demand, that does take time to appear in corporate financial statements. Typically, the pattern of bear markets is we see stock multiples contract first. That leads the market lower. We've experienced that this year. And later, followed by an earnings decline, taking the market down even further. So the chart on the next slide shows that in recessionary periods over the last 40 years, operating earnings for S&P 500 companies have fallen by at least 15% from their peak to their bottom. And so far, 2023 earnings expectations, they have indeed declined, but thus far they've only fallen about 8% from their peak. So it's about halfway, kind of the historical average. So I think to summarize these points, the message here is that we believe that because earnings still need to come down, that the market will likely come down alongside an earnings contraction, and markets are likely to continue to perform poorly well into 2023. So with not a great message there, maybe Steve, I can pass it back to you here, and you can give us an idea of when we expect inflation and interest rates, thereby stabilizing economic activity. Can we see some relief there, and which ultimately should help stock prices?
Yeah, thanks, Ryan. And you can go ahead to the next slide, Jan. Really, any relief is going to need to start with inflation. So let's talk about that. So goods inflation in a normal environment, it's typically very low. We saw large increases in goods prices and goods inflation in 2021, and the first half of 2022, as shown in the circled area of this chart. So global economies, reopened all at once after COVID. This resulted in supply chain disruptions, limited supply of goods such as autos, rental cars, furniture, appliances, you name it, etc. It put significant upward pressure on goods prices. Looking forward, there are signs that are pointing to a better year in 2023, as a lot of the supply chains are returning to business as usual, and rising goods prices are certainly easing. And as this chart shows, the goods contribution to inflation has been fading quickly. However, while we're seeing goods inflation fading or on the decline, core services inflation has been increasing, and certainly remains a real concern. And the largest contribution in here is from shelter costs, made up primarily from rents. And rental prices lagged the housing market by 6 to 12 months, and have been moving higher even as the housing market has corrected meaningfully. However, everyone's aware mortgage rates are elevated. They've stayed elevated. We're starting to see new listing rental prices coming down, and we do expect this component of inflation will ease more as we move through next year as well. So bottom line, as the chart illustrates here, there is significant economic data evidence that does suggest inflation has peaked and will be coming down in 2023. The Federal Reserve has finally started to talk about slowing the pace of rate hikes, and if this inflation trajectory holds, we will likely get some relief next year, but we'll be closely watching inflation as well as the labor market, which will ultimately drive Fed policy going forward. What we do know for certain, though, is that the bond market has priced a lot of this in. Bond yields are at the highest levels in over a decade, and higher interest rates mean higher forward-looking returns, as a great deal of value has really been restored across the market. And so with high-quality bond yields at 4 to 5%, riskier segments are anywhere from 7 to 10%. The bond market certainly looks compelling compared to a year ago. So we're closely watching the economic data and remain flexible, but to Ryan's question, we are likely to get some relief from rate hikes in 2023 if inflation continues to trend lower. So with that, I'll turn it back over to Jan.
Thank you, Steve. Okay, so until we see lower inflation numbers and less upward pressure on interest rates, now what have we done to properly position client portfolios based on the outlook we presented today? So I'll give you 7 takeaways. We'll start with number 1, which is defense first. In our opinion, this is not the time to be aggressive. And to start with, that means favor bonds over stocks. We especially like short-term, high-quality government bonds here, where you can get really 4 to 5% yield with very little risk. On the flip side, as Ryan explained, stocks we think may struggle for a little longer here in 2023 as interest rates, higher interest rates impact economic and earnings growth with a lag. Within stocks, we would favor value, defensive over cyclicals. So companies in defensive sectors such as staples and healthcare tend to do better during an economic downturn. In our opinion, it's very important to own real companies with real earnings in a difficult economic environment. And on that note, we remain underweight technology names, especially the newer technology companies, which, frankly, were very popular during COVID, but are still overowned. And we've seen many in recent earnings report, suffering really from peak penetration, regulatory risk, and when you look at valuations, a lot of these names are still richly valued. So regionally, I would say we continue to favor U.S. equities. U.S. equities tend to be a safe haven during global stock market downturns. So we favor domestic stocks over international stocks. The strength of the dollar is another reason to maintain our own bias at this point in the cycle. And domestically, we believe that industrial stocks are an interesting sector driven by really the end of globalization and the beginning of reshoring or onshoring, the idea of bringing back operations, bringing back businesses back to America as economic and national security reasons have forced many companies really to rethink their operations in China. Within fixed income, we remain cautious on credit as recession risk and credit event risk are still underpriced in our opinion. We are, however, becoming more constructive on interest rate risk or duration risk. We think we may be given an opportunity to extend duration in the first half of 2023 on a growing recession fear and declining inflation fear, but we're not quite there yet. So that's a story for the first half of 2023. And finally, a point maybe I made earlier, given the rise in short-term interest rates we've seen this year, we really like short-term, again, high-quality government bonds in the current environment. We think short-term, high-quality government bonds provide a really good risk-return trade-off right now. So these are the 7 takeaways or 7 portfolio ideas as we enter 2023. And this is essentially how we are positioning client portfolios today. So on that note, we have about 6 minutes left. So Leslie, we have about 4 weeks left before we enter 2023. So what should investors be thinking about in terms of planning opportunities?
Thanks, Jan. As we now are in the middle of the holiday season and nearing the closed 2022, we just wanted to briefly touch on a few tax planning items. TrustPoint recently sent out an article noting a handful of planning strategies, and so today I'll highlight a few of those. Given this year, the first planning strategy that may come to mind is tax loss harvesting. With the market downturn and the continued volatility, investors have the opportunity to sell funds at a loss and then use those losses to reduce their tax liability in 2022 or in future years. TrustPoint does have a process in place to review and implement tax loss harvesting opportunities throughout the year. If you may have higher income in 2022, or you would like to discuss your situation specifically for additional opportunities, please reach out to your relationship manager. We would certainly welcome the opportunity to assist with any additional planning. The other item that may be more top of mind this year is Roth conversions. If you have a traditional IRA, you have the ability to convert funds to a Roth IRA. Note that this is a taxable event. However, as we know, tax rates tend to increase rather than decrease. So by distributing funds from a traditional IRA, you're essentially locking in the tax rate of today and allowing the funds to grow tax-free in the Roth. Roth conversion opportunities are typically discussed when taxable income is lower for you in a given year, so you may look to max out your tax bracket with processing a conversion. Conversions also tend to be considered when there is a drop in the market. So funds can be sold within the traditional IRA. You're selling when the market is low, but you're contributing those funds into the Roth and also investing when the market is low, but then allowing for the rebound or the gains to occur in that tax-free Roth account. In regards to charitable gifting, you may consider a bunching strategy. With the increase to the standard deduction, less are itemizing. By bunching charitable contributions, you are alternating between taking the itemized deduction in 1 year and then the standard deduction in the next year. So this occurs by making multiple years contributions in 1 year to be able to itemize and take that increased deduction. And then in the following year, or maybe in the second year after, not making charitable contributions and therefore taking that standard deduction. If you have appreciated stock, consider making an in-kind gift to charity. The fair market value on the date of the gift is able to be used as the deduction. Note that if you are looking to make an in-kind gift from your trust point account to an outside charity, please plan to have those gifts processed by December 2nd for mutual funds and December 9th for stocks to ensure that your contribution is received timely by year end. If you are age 70 and a half, you have the ability to make charitable IRA distributions. By contributing directly to a qualified charity, the funds are not taxed, and you have the ability to contribute up to $100,000 per year. For the funds not to be taxable income, the funds must be distributed directly to charity and not first distributed to you to then make the contribution to the charity. And TrustPoint is able to help facilitate those payments directly to the qualified organizations. Another item to consider is making annual exclusion gifts. For 2022, an individual is able to gift up to $16,000 to another individual. So for example, I could give $16,000 to Jan, $16,000 to Ryan, and $16,000 to Steve. Note that if you make payments on behalf of an individual for medical expenses and tuition payments, those amounts do not count towards the $16,000 limit. So you are able to contribute over that $16,000 amount if payments are made direct to an institution for medical and tuition payments. And then lastly, if you have earned income, consider making IRA contributions to reduce your taxable income. An individual may contribute up to $6,000 for 2022, or if you are 50 or older, you have the ability to contribute an additional $1,000 for a total of $7,000. And then if you are in a high deductible healthcare plan, another way to reduce taxable income is to contribute to a health savings account. An HSA is a great tool to assist with medical expenses and offers the opportunity for additional tax savings. If you have any questions on any of these planning strategies, please reach out to a relationship manager. We can have a further discussion and then coordinate with your accountant if needed. With that, those are the planning strategies that I wanted to touch on today. So Jan, I will turn it back over to you.
Thank you, Leslie. Great information. So we are exactly at the 30-minute mark. So thank you, everyone. We'll conclude our presentation here. Steve, Ryan, Leslie, thank you for your insights, and all of you, thank you again for taking the time to attend the webinar today. We'll see you next time.